I started investing in 2020.
2020. Okay.
Yeah,
Was it after the COVID crash or before?
it was during the COVID
During.
crash. Yes.
You got in at the best time. Take,
She's rich now, man. She's balling.
yeah.
Yeah, ayy, the market hustle, helping you to succeed, teaching like nobody else. Financial empowerment, giving you strategies for generational wealth. So you can start helping yourself. More money for you to be getting. This the moment for you to be winning and be living financially independent.
Market Hustle community, welcome to episode 39. We have a special one lined up for you today, a completely new segment. And I have Baafi here, just me and Baafi. We're doing a group coaching session with a couple of people who decided to jump on and be vulnerable to ask some questions that maybe a lot of people in this community have. So we're excited for this one. A quick disclaimer. Make sure you do all of your own research as you go through this episode because we do cover and give our own opinions on certain things. And keep in mind, this is all for educational purposes. It is not financial advice. Make sure to just, whatever you decide to do investment wise, do your own research before you actually pull the trigger on investment strategy or style. But of course, this whole episode, we're going to be sharing, our raw thoughts and help give the group coach students some great insights to, ideally help them get moving in the right direction. Baafi, do you have anything to add before we get this session rolling?
Nah, man. Great intro. Super excited. And like Josh said, I see you wrap that up. This is your uncut, organic, straight to the point, vulnerable, and we're giving a little bit more of a curated answers and responses to help, the individuals that are going to be asking questions. And these are some of the questions that you potentially might have. And so make sure you're definitely tuning in and leveraging everything that you're going to see and hear us cover.
I'm excited for this one. Let's jump right in and let's see what they have to ask.
Let's do it. Yeah, what's going on, Lewis? Happy weekend.
Yo, what's going on, bro? Just chilling. I'm at my girl's house now. How you guys doing?
Pretty good, man. Pretty good. Can't complain.
Yeah,
How's the start to your year so far?
Pretty good, man. It was definitely you know, the very beginning was definitely freaking was definitely rocky because I was stressing a lot about my tests, among other things. And then when I was driving on the highway, the hood of my car just
Oh,
ooh,
wow.
Yeah, it just
Man.
flipped open. And that was like a week before my certification test. So I was just like, bro, what the fuck? Like, I can't afford this right now. And that was like the second time that it happened. And then there's other problems. The first time was my fault. But the second time, I don't know what the hell happened. And then, like, a few days before that, I went to go get it checked out because I think I was getting an oil change. And, excuse me, the mechanic also let me know, like, oh, like the catalytic converter's messed up, there's something in the brakes that's messed up, like just a whole bunch of shit messed up with the car. So I was like, you know what, bro, I'm just gonna have to get another car. I'm not risking this bullshit. And it was definitely like kind of a punch to the gut because I was like, bro, like I have my test in a week and I've been studying with this for months. Like I don't have time to be stressed out about this. But I was telling my girl, and I spoke with my mom too. Like, I was like, how I told you guys, I'm trying to get like more into my faith. And I was like, there's got to be like some kind of blessing in this that I'm not seeing right now. Like, I don't get it. Um, and then what ended up happening was when I took my test, like, I had passed it, like, all glory to God, because that test was
nice.
disgusting.
Congratulations on that, man.
Yeah, that's a
Thank you,
big
bro.
win. Congrats.
Thank you. And then like after like a few days, after like a week or so, I had ended up buying another car, a used car that I have now. And I'm happy with it. And then like the hidden blessing, I guess, like hit me because I was like, if I didn't have that issue with my car, I wouldn't have been stuck at home all day for like that last week. And because I was stuck at home all day, I just spent like that entire week like studying nonstop.
Okay.
And I was like, you know what? I'm gonna just take that as if I didn't study like as obsessively as I did, I wouldn't have passed that test because dog, that test was terrible, bro.
Nah, I like your approach on that challenge, man, and just the perspective you have on that in terms of like, yo, you could have looked at it completely different, but you're like, you know what? All right, it sucks. I got to sort this out, but it gave you an opportunity to just be home and study, and as a result, you did well on your test. So I think that's a very difficult thing for many people to kind of implement, right? Because life is just difficult, man. When it rains, it just pours. You know what I
Dude,
mean? And
yeah.
it always feels like it's almost like why always me type of thing. You know what I mean? So it's hard for people to kind of be able to step outside of just the pain, the uncertainty, the roadblock, and just look at and kind of twist their own brain, right? Twist their own perception to focus more on something that to get to get something out of it, right? To maximize it, to squeeze life out of it and go in the right direction. I think more practice like that is always going to be more beneficial than like looking at everything in the negative lens. Of course, things don't feel good, you know what I mean? But I think that's a really nice, mature approach and a good growth mindset challenge for you. It's almost like that's another testing of itself, right? It's like you can't be doing all this development stuff without getting tested, right? When you get tested, that's when it's like, okay, all the things I've been learning, now I get to put it to work. So seems like you executed pretty well. So good job.
Yeah, thank you, bro. I'm not gonna lie. It definitely took me a few days to get into that mindset because the first 2, 3 days I was just like, "Woe is me. This is terrible. I'm gonna fail my test now." Like it was a lot. It was a lot, but
Hey, but you got out of it. Like that's the most
yeah,
important call out right there. And you did your
yeah.
best to turn it into a positive or to think more in like the growth mindset side of things, which really, like you said to yourself, like you could give that a lot of credit to helping you actually study more and likely credit that to like actually pass the test to begin with.
Mm-hmm.
So, it shows like the growth, like the mindset growth and just being willing to kind of convert from that initial shock and just like that wave of everything you're having to deal with, like all the bullshit happening, to converting that to like, what can I control? Like, how can I make this situation better? And obviously that benefited you by willing to, pass the test and then, of course, get a new car, like get all that situation handled. Because it's easy just to stay in the negative side of things and then just to say, like, everything sucks. Like my life, I have the worst luck and everything's, always bad. Like it's very easy to stay in that mindset, but it's super counterproductive. So the fact that you kind of zapped out of it, Lewis, is such a important call out and something to be proud of.
Yeah, I appreciate it, bro. I appreciate it because yeah, man. And then there's the obvious fact, like, bro, I was going 80 miles an hour and my hood flew open. I could have very much been like unalived. I don't know if I could say the other thing because I know you guys don't
Right.
Spotify.
Yeah, it could have definitely been worse, man. But hey, yeah, I guess you got a convertible out of it, maybe, just for a little bit of the ride.
The 2018 Ultima, bro. No convertible yet. No convertible. Give me a
That's
few
cool.
years.
That's what's
But
up.
after that, honestly, everything else has been good. Like now the
Mhm.
promotion is great. Just adapting to the new position. But definitely like the income is changing now. So now it's taking care of, some debt that I have with, credit cards that I accumulated in very stupid ways. And then now I was gonna text you privately, Baafi, to see if we can coordinate
Mhm.
like a meeting. So now like with this range, because like the hours
Right.
range in my field, it's not really like, oh, you're gonna get 40 set hours. It's very high.
Gotcha. Okay.
And
It varies.
yeah, so I was gonna
Yeah.
see if have a meeting so that I could coordinate, okay, this is how much I'm expecting to bring in, ideally
Hmm.
more. But now I want to be able to understand that, okay, I want this to be the first year, assuming that I can, eliminate that credit card debt within a
Right.
few months. I want this to be like the first year I can actually like max out my Roth IRA.
Nice. Wow. That's awesome, man. No, absolutely. For sure. For sure. You already know, like, when it comes to making progress, especially as your income get better and you're already thinking through things the right way anyway. So I will have some time to give you some more insight and kind of structure something that works best for you. But yeah, we're gonna come back and celebrate at the end of the year.
Oh,
When we get to the end of the year, we see what all the accomplishments that everybody's having and the goals that are being smashed. Like this is gonna be cool. I feel like this is a year everybody's like not messing around, bro. It's
mm,
like because at a certain stage, it's like okay, I'm either gonna get this thing done or I'm not, right? And then as you get older, it's like you need to. It's like your life requires you to have more to show for. You know what I'm
mhm.
saying? It's like ideally you don't want to get to 30, 35, 50, 55, 60, and you have like nothing to show for it and kind of complaining or blaming something or someone No, at those stages, nobody's gonna really, give you as much sympathy or as much grace as you might even deserve.
Yeah, definitely got to set it all up. But I appreciate you guys with the Discord and all the advice that you guys give out. Every now and then I hop on IG and I see your guys' posts. So it's
No
also
doubt, no doubt.
because we're definitely in the minority of most people. So sometimes it's like, damn, like I really want to go out and bread, but I've got other stuff to do.
Yeah, it's not easy, man. It's not easy. It's actually difficult, though. It's simple, right? Like
hmm
it's simple. It's like, all right, I do X, Y, and Z. I'm probably gonna get X, Y, and Z. It's easy math kind of thing. But
Mhm.
to execute it is very, very difficult because you're dealing with human psychology, you're dealing with human emotions, human experience, and with social creatures, and all these businesses spend a boatload of money making sure that everything you see you want to get, everything they have you want to buy. You know what I mean? They do a good job of circulating that, and then social media, the rest of the public does a great job for these companies as well, right? Because people like to share all the good things or the things that look good in their life. When they go out, they're sharing that, but they're never sharing when they're like, struggling on one hand. So it's hard. It's not easy at all. It's not easy. I mean,
Especially like dealing with setbacks, man. Like when setbacks hit your
yo,
life, Lewis, like
fact.
you can speak to this, just recently. Like it's very easy just to kind of throw everything away, like all the progress you made, and just be like, screw it, and just kind of take the easy way out moving forward to kind of deal with those short-term blows. But it takes a lot of mental resilience to kind of step back and get yourself back on track, or like start thinking more in the positive side of things. And ironically, like what that does though is it actually, gets things moving in a better direction faster, which of course you're living proof. You've had the big accomplishment of passing the test. And, now you're sitting here talking with us. Like we're gonna, I know you have a question around, building out your ETF portfolio, or like figuring out, we'll kind of dive into that a little bit later. I want to make sure we help you kind of tweak things. Baafi and I will share our perspective. I also want to just quickly, looks like we had another member jump in, Queens. Queens, how you doing? Are you, can you hear us okay? Let's see if she's
Yeah, it seems like Queens is like on the chat more
okay.
than voice because maybe I mean could potentially be at work or so I think it
So
definitely.
yes,
Oh, there
I'm
Oh
she
yeah,
is.
okay.
How's it going, Queens?
it's going great. Well, I ain't gonna say great, but it's going.
What's been on your mind? Like how are things starting off in the beginning of the year? Any like questions that you have, or situations maybe you're currently dealing with that maybe Baafi and I can help give perspective, especially when it comes to the finance side of things?
Definitely. Is it better to invest a lump sum or just have it like dispersed monthly?
That's a good question. Baafi, do you want to tackle it first? Give your thoughts.
Sure, sure. So Queens, I think the bottom line is it doesn't really matter as long as you're investing for the long term, meaning like multiple decades. You can do one lump sum or you can dollar cost average, which is the second part that you mentioned, is breaking it down into smaller chunks for every month, right? And you invest it that way. Now, the reason why it doesn't matter ultimately is because in the long run, you end up the same spot for the most part, whether you're doing one lump sum or you're breaking it up monthly. Also, everyone's situation is a little bit different, right? Some people might get, I mean, it's almost tax season, so somebody might get a 3K or 5K tax refund, and they might decide, hey, they're going to invest that 5,000 lump sum right away because they don't really have a lot of flexibility in their finances due to their responsibilities or circumstances to actually fit a contribution amount on a monthly basis in their budget. So either way works. I think it comes down to personal preference, and you can go either way. There's no like wrong answer there.
Definitely. Um, I guess to help maybe give you a more curated answer as well, because Buffy's spot on. Like it does kind of depend, either route technically works, but there might be a better route for you to lean towards depending on kind of where you're at. Could you share maybe like where you're at with what you've invested so far? Like how long, like when did you start investing? How you actually started to begin with? Let's start there. Like let's get some context around like where you're at on the investing side of things.
I started investing in 2020.
2020. Okay.
Yeah,
Was it after the COVID crash or before?
it was during the COVID
During.
crash. Yes.
You got in at the best time. Take-
She's rich now, man. She's balling.
I wish I was, but I was always scared. Like when I was in my 20s, I was always scared to invest because I'm thinking I don't want to lose my money in the stock market. But as I got older and started researching and learning and looking, I'm like, okay, scared money doesn't make money.
Mhm.
So I can't take it with me. So I started investing, but I didn't invest that much. I basically started off in Cash App, and I
Okay.
don't have that much in Cash App. Then I moved from that um, with Fidelity through the company that I was working for. Then I started doing that, and then I have some tax, um, no, non-taxable accounts through Robinhood.
Gotcha. Awesome. Well, yeah, it sounds like you have like your foundations being built. And I mean, the fact that you started during one of the biggest crashes that we've had in like the last 15 years is huge. And my next question though, like I want to see just so I can like paint a better picture, because I want to be able to like give you a good answer. And I think Baafi and I can both touch on this. How about how did you do like during 2022? So like we had the recent stock market crash. You know, we had the whole Federal Reserve was like hiking the rates, and a lot of investors were starting to kind of panic. I'm curious to see if that kind of worried you, or like how you kind of maneuvered during that time period, as well as maybe just like how consistent you've been. Like, do you feel like you've been consistent with investing, or is that still something you're kind of trying to fine tune?
So starting in 2020 in Cash App, I did not invest that much in 2021, 2022. 2023 is when I really started investing, like putting thousands of dollars in
Nice.
and really investing. I had just got to the point where, I mean, even though it goes down, it's going to come back up.
Mhm.
That's my mind. That's my mindset. And I know we can't time the market, but I'm always trying to look for red days
Mhm.
so I can buy something. But
Well, and you got spoiled, you know, starting in one of the best red day periods. So like you see, you started during a time where you were taking advantage of these massive sales. It's like, of course, that's such an important lesson to learn. Being able to take advantage or reframe how you view red days as a positive thing rather than something to fear. So that's great. Um, I love that you're like investing more, like you're getting more aggressive with it. You're taking, you know, you're kind of like leveling it up a notch in the last couple of years, like 2023, and I'm assuming 2024 as well. That's awesome. So when it comes to the lump sum slash dollar cost averaging, like should you just jump in, throw everything in that you got right now, or kind of slowly enter over the next maybe year or two? I would say one key thing that maybe we can dive into a little bit deeper is first off, what you're currently investing in. Like, are there specific index funds you're jumping into, or stocks or crypto that you're looking into, as well as maybe, yeah, let's start with there. So, like, yeah, what exactly are you investing in right now, if you don't mind sharing?
um, currently I have I have a Roth and I have VO, VTI, VYM, and I think VGT in the Roth.
Oh,
Um,
okay.
then I have Robinhood. I also have some VOO, VTI, QQQ, SCHG. I mean SCHD.
The dividend. Okay.
Yes. Mm-hmm. And the lump sum that I wanted to do is actually from another employer, and I had to roll it over to an IRA. And I was
Mm,
thinking about either SPLG or what is it? FXAIX. I think that's the Fidelity one.
the FXAIX, the S&P 500 Fidelity.
Yes, that one. Yes.
Gotcha. Okay, cool. Um, Gotcha. So we're doing a rollover from an old employer plan, and right now it's sitting in cash.
It is.
Okay. And before it was in cash, what was it sitting in with your previous employer? Was it in a specific funds,
It was in a target date fund.
target date fund? Okay. Gotcha. So based on all of this, I'll give you my thoughts. Like I think I have a good enough information to give you a good answer that I would lean towards. And then of course, what Baafi said from the beginning stands. Like either route you can go. For me, like it sounds like this was part of your long-term investment plan. It's coming from like that retirement side of the equation from your last employer. And when it comes to investing, the biggest winners are the people who have the most money invested at any given time. Like their money is put to work. It's you're using it to buy ownership in some of these massive corporations that are continuing to create new products, create, innovates, change how they're kind of maneuvering through the business environment to make more profit. Like if there's one thing these companies are good at, it's making profit. And when you take that money that you have to own a piece of what they are building or doing, like you're constantly going to benefit every time they generate more profit and every time they build new products or start to take advantage of this AI stuff, right? Where if your cash is just kind of sitting on the sidelines, it's not doing anything. Like it's not productive. It's just kind of sitting there. Like you might be earning some interest, which is great. But if your plan is to play the long-term game or build long-term wealth for yourself, my opinion is you should get as much money in the market at any given time. That way it's working for you. Like you're going to benefit no matter what plays out over the next 5, 10, 15 years. Like, of course, the short term, there could be some, bumpy moments, especially right now with what we're dealing with, like, the trade, the tariff stuff. There's going to be a
Right.
lot of uncertainty in the short term. But I think sitting here waiting for like the best moments could potentially, like, although you could potentially like, squeeze in a couple of percents, get a couple of extra percents in your favor, you also do risk potentially missing out on more growth, especially if we do see inflation. Like if inflation starts to spike, what people are going to do is they're going to take cash and buy assets because like they're not going to want their cash to be inflated away.
Right.
So I would say it's even more important in this environment to own quality assets, especially like think about these 500 businesses with the S&P 500. Like these are some of the biggest corporations that have the best resources, the smartest people in the world working for them, and they're the most like business profit savvy people out there. Like they're going to find a way to make profit. Like even if something gets cut off temporarily, they're going to find a way to maneuver through the new business environment and continue to profit for themselves and then of course the investors who own those companies. So like my thing would be like, we want more of our money working for us at any given time. Um, Rather than just sitting in cash, especially if your goal is to invest for the long term, like 10 plus years. And that money's coming from a place where it was already invested to begin with. So like my thing would be like, why not just get it working, continuing to work in our favor and just jump back into the game in FXAIX. Baafi, what do you think? Do you have any thoughts on that as well?
Yeah, I think that's a really good insight right there, right? Because the money was working already. So it's almost like, you got a company, you're doing great, your employees are doing great, and then you fired them for the meantime. But it's like the only way they can continue doing great and giving you what you need is to put them back to work, right? It's the same thing with the money. So if it was already working and now you got it in cash, it's no longer working. So you want to get it back to working as quickly as possible. Now, because it's a rollover, it should be quite comfortable and easy to do. And then I think going forward, you can probably
Mhm.
then dollar cost average, right? As more as with like new money that comes in that you can contribute to. So that way you don't skip a beat essentially from your previous, account to this account. Like it's almost like seamless, and you just continuing to build on top. So I think that's, in my opinion, that's the best move. And then I think you've been very smart in how you've been building your foundation. You have the right funds, right? You got VO, VTI, VY, and VGT. You have QQQ, SCHD. Now you're thinking about, hey, let me get FXAIX. You're doing it the right way, and honestly, that's all you kind of really need. Like uh, you don't have to overcomplicate it. You can keep it that smooth and just let the money do the work. You enjoy your life. You throw more money in when you can.
Okay.
Is there anything like worrying you that would prevent you from making this move, Queens?
No. I was just trying to decide, should I just throw it all in there now since it's sitting in cash, or just dollar cost average it through the entire year?
Yeah, that makes sense. Yeah. I think you're in a fortunate position to be able to throw a decent amount or lump sum in there. So for many people, it's like it's not like they have a lot of money just sitting on the side, right? Or unless it's a rollover 401k type of thing, like the situation you're in, or you get a lot of tax money, or you get gifted some money or something, or like a bonus from work comes in and it's sizable. Majority of people don't have a decent amount of cash just sitting there. So that's why they tend to opt into the monthly dollar cost averaging, because at least if they can get 200 in there, they can get maybe 300 monthly consistently. Cool, they will do that, right? I think in your case, you have the luxury of both, and so you can go lump sum, and then going forward, you can continue with your monthly contributions.
Mhm.
Okay. What do you think about adding stocks in with it?
Like individual stocks.
Yes,
Okay, and these will be. It depends on the account as well, right? I would say if it's more like your retirement account, I
it is.
wouldn't. Yeah, I wouldn't recommend individual stocks in a retirement account, and the main reason is not because individual stocks are bad, right? At the end of the day, they can 10x and do some incredible things. The only challenge is that, or the main risk with that is, nobody knows what the company is going to do 10, 20, 30 years from now,
Right.
right? Even the companies themselves
Right.
don't know. That's why they always like, tweaking everything they're doing and trying to stay ahead of the curve and try to predict and have these models and forecasts and all these things. They don't even know where they're going to be at, right? If you look at the last 30 years, there were companies in the 90s that were like on top of the world, right? Today, they're not even in like the top 100 companies in the world. Like a lot of them are gone. You know what
Yeah.
I mean?
Right.
So I think that's the risk in adding individual stocks to your retirement account, because yes, these companies might be great. Apple might be amazing right now. Nvidia is like the darling right now, the poster child, and it might be amazing right
Right.
now. We don't know what it would look like 10 years later if some other firm is going to come in and kick everybody's ass,
Hmm.
you know?
Right.
So I think that's where it makes it difficult for retirement account. Now with taxable brokerage accounts, I think you can work individual stocks in there, whereby your index and ETF foundation, in my opinion, especially if you're not as familiar with the individual stocks and how to weather that emotionally as well, or know a lot about the company, I think you might want to have a situation where you're like starting off in terms of like 90% ETFs and index funds, and then maybe 10% individual stocks, right? But with the individual stocks, you want the companies that are the best of the best. You want the ones that are extremely profitable, that know how to manage money, not even just from a business perspective, but from a life perspective. We all literally depend on them, right?
Hmm.
And you can easily kind of rattle off a quick five or four individual stocks, whether it's Apple, Microsoft. Right now, you got Nvidia, you have Google, Amazon,
Right.
right?
The Mag
Meta,
Seven. Okay,
right,
the Magnificent
exactly.
Seven.
So I
Okay.
think those are really good, healthy starting points. And
Well, and just to add some extra context, so the cool thing with these funds, so like FXAIX or any S&P 500 funds, is it's going to adapt to like whatever the hell happens in the future. So for context, like 30 years ago, the big companies in the S&P 500s were not the tech companies. They were the energy companies, the oil companies. Like those were the ones that were really pulling in a lot of profits, 30, 40 years ago. Where, recently it's been tech, more of the software, like the Googles, the Metas. Well, now we have NVIDIA as well, the semiconductors. But the cool thing about these funds is they're constantly adapting, and they don't require you to have to sit here and predict which companies are going to do well in the next 5 to 10 years, or try to sell, like find the right time to sell some of the stocks in the fund. Like it's just automatically going to adapt to the business environment without you having to do a thing. So if 10 years from now, some AI robotic companies, like if that starts to be the hot spot in the business world, well, the S&P 500 is going to adapt to that. It's going to start weighing or pulling more of the funds, putting more of the money in the fund or the resources towards those type of companies without you having to even sit here and do a thing. So it's really a great on that aspect because it takes yourself out of the equation. But it's even better because it's your retirement money. It's like the good thing with these funds is like you can know that your odds of retirement are going to be a lot more likely because you're going to be constantly invested in the best companies in any given era or time. Where with the individual stocks, like I think there's nothing wrong with wanting to have some like have a portfolio of individual stocks. I agree with Baafi. It's probably better to have it like in a side portfolio, like with a taxable brokerage account. If you're going to pay attention, I usually say like you want to dedicate at least 2 hours per month for each stock you want to buy, just in keeping in touch with what they're doing, how they're changing, how they're making money, what's going on in the business environment they're operating in. Like you got to be willing to kind of keep an eye on those different areas. And if you, I would say at least 2 hours per month for each stock you have, and keep it minimal to like just a small portfolio to start with, and then give yourself time. Like if 5 years down the road, you start to become a great stock picker. Maybe you're like the next Nancy Pelosi. You're just like picking the right stocks every time. Start to like pull more of your portfolio towards the individual stocks. But I think for at least like the beginning and building your foundation and getting everything set for retirement, it makes a lot more sense to stick with the index funds and then just try out your stock picking skills with a smaller parts, just to kind of keep your risk at bay and make sure you're set up to at least retire eventually, rather than having to hope magic kind of takes its play and you find some quick winner that saves the day.
Yeah.
Understand.
Yeah.
Understand.
Individual stocks are very interesting because they, like Josh said, they require you to actually do a lot more work because you have to keep up with the company, their performances, what's going on in the business. And at times you might have some flexibility. Most of the time you probably might not have that much flexibility, or you forget to, pay attention to what's happening. And so when it comes to retirement accounts, your best bet is to guarantee yourself, a pretty healthy retirement, which is your ETFs and index funds. And then when it comes to stock picking, you might want to look at it a little bit more on your taxable brokerage account. And even then, you want to dabble very small to start, right? You want a strong foundation. One of the reasons why I said that you probably want to have 90%, at least 90% in ETFs and indexes for the taxable before you start messing with individual stocks is, let's say you are 90%, you pick five individual stocks, and each of them ends up being, let's say, 2%, right, of that taxable account portfolio.
Right.
The reason why you don't want any individual stock to be big in your portfolio is because then it controls the entire weight and swings of your portfolio, right? If one stock is 10%, that's not good, because if that stock goes down 50%, your portfolio is already down 5% from the top,
Right.
right? Because it's too heavy in there. And also, you don't really want any individual stock to get too big. So with individual stocks, you want to kind of keep them around 2%. Sometimes you might get a lot of growth on it and it becomes like 4 or 5%, which is amazing. But you want that high, like that 4 or 5%, to be more so related to the growth that you've gained versus your actual money that you've put in, right? And so let's say five stocks, each is 2%. Let's say 10 years later, each of them become like 5%. They're bigger. Then you would simply just revert back. And now when you add money, you would just add money only to your indexes again to get those indexes to back up to 90%, right? So you
Okay.
want that way, it helps reduce the risk and exposure to the individual stocks, but you kind of get to have your cake and eat it too all the time. But that's like a little bit down the road. I know right now you're contemplating on whether you should add individuals a little bit or not.
Well, I
But
already
that's just
actually
a good
have
strategy.
um
Hmm.
I already have individuals, and my portfolio that I have in Robinhood is like that. About nine
Okay,
index funds or
good.
ETFs and 10% or less in
Hmm.
individual stocks.
Cool.
So I
Nice.
still have that flexibility. So that lets me know I was on the right track
Hmm.
of doing that. So
Nice.
I know the SPLG and FXAIX, both of them track the S&P 500, but I know the SPLG is a lot cheaper than the F with FXAIX. What is your preference of the two? Even though both of them
Hmm.
track the S&P 500.
Right. So basically you're saying the price difference is one is cheaper than the other because of the how much each share cost, right?
Right. Like
Okay.
the SPLG, I think the last time I looked, it was like $70 and something. And
Hmm.
FA FXAIX, I think they're at what, two something.
Right.
Yeah.
So, yep. So there's a thing with these funds. So for like each firm can basically kind of have their own version, but they all track the same exact thing. So even if SPLG is $70 and FXAIX is $200. They technically are the same. It just boils down to the number of shares divided by the market cap of like what the fund overall is, right? So the best way to look at it is by percentage, not more so the dollar amount. The reason why I say percentage is because if the market goes up 5%, right? S&P 500 goes up 5%. Guess what? The $70 version will go up 5%. The $200 version will go up 5%, right? So they're essentially the same, even though they're just dollar wise, each share varies a little bit, but they actually perform the same. Now you might look at it and be like, okay, well, if I have 1,000, I can have a lot more shares in SPLG, and you might do it
Right.
that way. Or you like, oh, if FXAIX is $200, I can only have 5 shares.
E-
Yeah, right. Ultimately,
That's how I
you
was
want more.
looking at it too.
Yeah, ultimately you're thinking about the quantity, right? Like how
Right.
much more can I stack?
Right.
Which is good, which is good too. So you can't really go wrong there. Sometimes emotionally it just feels better because let's say I have 15 shares versus 5 shares, you know what I mean? But is ultimately the same, really.
Okay.
Mhm.
Yeah, I feel like Buffy's right because even like mathematically, if they both go up 5%, like let's say you have, let's just say that the FX AIX is 280. So it's exactly like 4 times the other one. If
Right.
both grow 5%, you can either have 1 share of the big one or 4 shares of the little one, but like the gains will be the same
Mhm.
because you have more shares of the smaller one, but the bigger one will just grow more because it's bigger. You know what I'm saying?
Okay.
It's a,
It's
it's kind
it's
of
pretty
like what he
much the
said.
same.
Like it's gonna give you basically the same thing,
Yeah.
but it'll just be like that psychological thing. Like, do you want to have less bigger shares or more smaller shares?
Smaller shares. Gotcha.
Yeah.
Yeah.
Yeah, and if you want the more shares, SPLG is the way to go because like you're going to be able to have like you
Mhm.
know more. You'll have technically more shares, but yeah, either way, it's really just a personal preference. So
Mhm.
if you like the cheaper price because maybe it allows you to invest more often rather than having to save up. Well, I mean, most brokerages have fractional shares, so you can still invest no matter what. But some people do prefer to just have, they like to see the number of shares going up. And if
Mhm.
that motivates you to invest more, go with SPLG,
Yeah.
whatever works.
Yeah.
Okay, thanks.
Good question though.
Yeah.
Um, yeah, I mean, I think dollar cost averaging, the lump sum slash should you slowly enter the market is a classic question. And really like what Baafi highlighted in the beginning, you can't really go wrong with either routes. I mean, the good thing with investing right away is you're going to have more of your money working for you at any given time. And that's always a plus, especially with us being long-term investors. Like we want to put our money to work rather than sitting on the sidelines. But I would say
Right.
for newer investors specifically, if you're just getting started, maybe this is like your first or second month in the stock markets and you're still not really sure how you'll handle red days or market crashes, then it might be better to kind of slowly enter, like kind of slowly dip your feet in the water before you just jump right in. But obviously, like Queens, like you've already experienced market crashes. Like you literally got started during the best time ever. So to me, it makes sense to just jump right in. And I'm mostly just like reiterating this for everybody listening because we're recording this and I want to make sure people just have the right context. Like there's really no right or wrong answer. The right answer is just actually investing. So like if slowly entering gets you to invest and it gets you to stay consistent with it, be my guest, go for it. However, if you have the confidence and you can withstand the ups and downs, then it's better to get more of your money working at any given time. And then I'm glad we were able to touch on the differences between different index funds because it can get confusing with how many different funds are out there that do the same exact thing. There's
Mhm.
I want to say there's like 20 or 30, maybe even more S&P 500 specific funds. So like they all track the same exact index and they all go up and down the same pretty much percentages. But they're going to be all priced differently just because they're different funds managed by different companies. And a lot of people get kind of overwhelmed. They're just confused. They're like, which one should I pick? Which one's better? It's like, well, technically none of them are like better. Like, of course, you can look at the fees each fund charge. Like some of the funds have slightly higher fees. But even I just looked up the FX, AIX, and SPLG, and they both have the same exact fee. So given that, like it's really just a personal preference. So like if you're the person, it sounds like Queens, like you might benefit from just going with SPLG just because you're going to be able to see the number of shares kind of getting stacked up higher. And if that helps you with the momentum and staying consistent with investing, like that's the main goal. Like that's what we want you guys to do, is like to stay in the game and to stay consistent with the game, because that's where the magic happens. That's how you get this massive wealth machine called the stock market working in your favor. But great question, Queens. And I'm really
Yeah,
excited to upload this because I think it's going to help a lot of other people who have
I
similar
agree.
questions.
I agree. And Josh, I think one cool thing about lump sum is it can be a nice way to actually contribute more in general, you know. And the reason why I say that is because some of us might get, like I said earlier, a bonus check, referral check, tax returns. And if we let that money sit too long, you know what tends to kind of happen, right? Like now you're negotiating with the money, and you're like, you know what, I'll spend, if it's 5,000, you're like, I'll spend 1,000 and invest four. You spend 1,000, there's four left, and then you're like, well, this is coming up and this is happening. Next thing you know, the whole money's gone. Right? So for some of us, it might be a good psychological trick to kind of help us contribute more is when that money hit the account, it hit your checkings, you just kind of reroute it right to the brokerage and invest it. That way it's not sitting in your checkings or savings, and next thing you know, it kind of disappears. So if it's money that you don't readily like really need, right, in the short term and whatnot, and it hits your account, you get a tax refund. For anybody that is listening, I know tax season is coming up, so everybody's gearing up. I actually got my W-2 this weekend, so I still got a few other accounts that I need the 1099s for. But if you're thinking about taxes, this might be one of the best ways you can kind of contribute to your portfolio, right? Because sometimes it's hard to contribute on a monthly basis. Life happens. Lewis just told us his roof blew off and he had to get a
Mhm.
Oh,
new car
wow.
completely, right? So some of these things are unpredictable. So when you get lump sums and you have the opportunity, if there's flexibility, I'm always a big proponent for just kind of leaning in the market a little bit more. Because even after that, if you're not able to contribute much for a while, you can say, hey, at least I didn't ignore that part. I got some money in the game. I'm still balling.
Mhm.
Yeah, that was my actually goal from when I get my tax returns, to put more in mine and also put 1,000 in each of my kids,
There you
that
go.
I have for
There you
Nice.
them.
go. Love that. Love that. Yeah, I'm waiting for
Yeah.
my performance bonus from work. I need that thing to come in, man. And it better be nice because I would be pissed off. I'm looking to invest that as well. I haven't contributed to my regular taxable brokerage account this year yet. That's gonna be the main piece to make up for January and February of not contributing. So sometimes I use that to catch up as well. So that helps.
But great questions, Queens. Thank you for those.
Yeah.
Lewis, let's get you up here. Let's jump into the next one. I know Lewis has a pretty good question that I've seen quite a bit. So I think this is also going to help not only Lewis, but other people who are listening as well.
Yeah, I've got a few questions, like the one that you already know that I dropped in the chat, and then others that I've been thinking for the last week because now
Mm-hmm.
I'm like, what style of investing do I want to go for?
Mhm.
Like, well, the first one is, let's just get that one out of the way. Like the indexes. So I remember, I don't know if you remember, Baafi, the call that we had that got me into Fidelity, where I
Right.
had $200 to start, and I was like, what the hell do I do? And
Yeah.
then we had agreed on VOO, VYM, VUG, and VGT, I think it was.
Yep.
So I started off with those four, and
Mhm.
I'm pretty sure. Hold on, let me check real quick. I'm logging in right now.
Nice.
That what I have happening is like every week, like I get paid weekly right now with the company that I'm with, and it's just every week, like just a small dollar amount for now because I've got the other stuff I'm dealing with. But I didn't want to break my investing habit. I have like a small amount of money just going into those four on a consistent basis. And then every week on Wednesday, I think I just have like $25 come out. So I have like cash sitting in the account. So whenever I'm ready, like, hey, like, I think I see like a good buy opportunity, I just have like, after a few weeks, I have like a few $100. So like
Hmm.
right now, I have like $300 in buying power, but
Nice.
I'm like torn on what to do with it. And
Gotcha.
I feel like I'm worried I have too many things in my portfolio right now. And I'm not really like centralizing on anything. So I feel like I'm missing out on gains because I just have so little in so many different things that it's like no matter which one goes up a lot, I'm not going to make a lot.
I see what you mean. Okay. Yeah, great point. So first, I want to ask, how are those funds doing for you so far?
So far, let me see. I'll tell you. Uh, Most of them are green. I have one, well, in not Nvidia. I have one, two, three, four, five, six, 7 funds, and they're all green except
Mhm.
for SCHD and SOOX. I mean
Gotcha.
SOX.
Gotcha. Okay. Well, I see. Okay, that's fine. So that's good. I mean, overall, you're definitely well diversified, and I
Mm-hmm.
think, and your question is valid. And well, one, I'm glad that the funds are doing well for you. Secondly, I'm glad you didn't break that habit of having some money going there consistently, and then the added layer of having a little bit of cash. So when things you get a nice little dip, you can take advantage of those sales. So that is smart. Really, really smart. Um, I understand where your question is coming from because if you're not contributing, I would say a sizable amount of money, right? It can seem like it's almost like you spread yourself thin. Like you
Uh-huh.
can feel like you spread yourself thin, right? And so you might be thinking a little bit more consolidation or more concentration in like, let's say 1 or 2 funds, because then that way you will see the gains a little bit like visually, it will look better or it probably helps you out a little bit more in the long run.
Mm-hmm.
So, I mean, I would say the funds you have are good. And if it's 7 different funds, you can easily, if you feel like, hey, I want to kind of consolidate a little bit more and I don't need to have 7, you can certainly do that, right? You can have just 3 and do phenomenal, you
Mm-hmm.
know? And so you can literally decide, hey, I'm going to do VOO, VUG, VGT, and you can do those 3 because VOO you're gonna get some dividends along with good growth, right?
Mm-hmm.
VUG and VGT you're gonna get some solid growth as well. And
Mm-hmm.
you can stick to like just a 3 fund approach like that and just kind of be able to go a little bit more heavier in each of them. If that
Mm-hmm.
helps you invest more consistently, if that helps you see the returns in a better way, if that helps you continue feeding the machine and benefiting from it, and you feel good about the direction you're going in, you can do
Mm-hmm.
that as well, right? That's the beautiful thing about it, investing in the stock market. Your strategy don't have to be rigid, right? It's not like, well, for the next 30 years you can't do nothing else. You have to be locked into this, No, you have some flexibility, and at times that might have been a good way to start and kind of diversify your risk more. But maybe as you develop and you get a better understanding of certain things, you might see a better strategy that will meet your needs, right? So it's good to be flexible. I know Josh is about to touch on some other important points there too.
Yeah, no, I think it's great because like you have it does sound like you have quite a bit of funds in your portfolio. The good news is like you're getting a feel for how they kind of work in your portfolio. So like you're getting exposure to different funds. And because you're early in your investing journey, relatively speaking, it's going to help you fine tune things kind of moving forward. So like by now you probably have a good I'm sure you have a good selection of which funds you like best in your portfolio and maybe which ones you kind of like worst. So like
Yeah.
moving forward, it's going to be easier to maybe fine tune the strategy. And I do agree with Baafi. And just based on your question, like I think it would be beneficial to maybe simplify things even more. Like
Mm-hmm.
maybe instead of 7 funds, you aim to get down to like 3 or 4 moving forward and just kind of just concentrate on more of the broad funds. So whether that's, VOO, I think should be like a staple in almost everybody's portfolio.
I
That
love
should be
Apple.
like the core position. Yeah, it's great. You
Uh-huh.
get the growth and you still get some dividends. So it's a best of both worlds, so to speak.
Mm-hmm.
The way I kind of think of it, here's an example portfolio of something you could do. You could do like 60% in a core position, such as VOO, and then maybe you do 30% in more of a growth, like a high growth or like a higher risk type of fund like VUG or VGT. Like that could be like your big growth aspect of the portfolio. And then maybe you could do 10% in something that gives you a little bit more of a hedge or a little bit more diversification, such as like dividend specific funds, if you want to do like SCHD, or it could be, just pull in another fund that you currently have and add it to that 10% part. So like if you
Yeah.
wanted to go like a simple 3 fund portfolio, that's one example of how you could approach it.
Mm-hmm.
But I do think just moving forward, even if you just start focusing like maybe over the next 6 months to a year of like eliminating 1 position or 2 positions and then just like more fully focusing on some of the core parts of the portfolio you want to grow, I think that would be wise kind of moving forward based on the question you have.
Yeah. Yeah.
Okay.
Yeah. So
Yeah.
that's a really good question. That's a really, really important question, actually. Yeah. So that was good. Yeah, you can definitely do a three, ultimately get down to three good funds and you're good and you're chilling. And especially now that in the near future, as you get rid of the credit card pieces, you're gonna be able to contribute more. So you're gonna see it even more in by just having even three funds. Yeah.
Yeah. See, and then that's the funny thing is that so the main four that I started with, I already told you VYM, VUG, VOO, and VGT. Those are the ones that I started with, and those are the ones that are just they're the ones that are consistently getting
Mm-hmm.
the weekly, contributions.
Mm-hmm.
I think I think I got into VIG because I had heard that that one was a good one to get into. Which one is VIG? I think that one is dividend appreciation index fund. And then I remember I got into stocks because I think you had talked about stocks actually. Wasn't
Yeah.
you?
Yeah, I definitely mentioned stocks before for sure.
And then the one that I have the most shares of is SCHD because this is where like this is the next question where I'm like I don't know how I want to approach this.
Mm-hmm.
So
Okay.
I think I asked this, but I don't remember before in the chat. I'm stuck between dividend and growth. I don't know which one I want to do
Nice. Nice. Yeah.
because I obviously see growth has more potential. I guess I'll say because we both know that the growth funds can skyrocket.
Mm-hmm.
So I'm stuck and I'm 26 and this is all my Roth IRA and for future reference, I'm never pulling a damn penny out of my Roth IRA until like
Mm-hmm.
I'm
Yeah.
old. Like
Right.
I don't touch that at all ever. So I'm debating, do I want to take advantage of this time and go for growth because obviously growth can grow more, hence the name, or do I want to just go crazy on dividends so then in the future I can be raking in
Mm-hmm.
dividends and then start replacing some bills with dividends? Like I have this talk with my girl. I hate the idea of monthly car notes. I hate it. I can't convince myself to freaking do it. But if I'm raking in enough dividends to cover the car note, then it's like, okay, now I can somewhat justify my Corvette with my $600 car note or $700, $800 car note because my dividends are paying for it, not me. And then the other thing that I think about is when it comes to like me being retired and living off my portfolio, like I know the 4% rule. So, just pulling 4% a year and you should be able to float on your portfolio forever. But one thing I thought about is like, okay, now what happens in a recession when my portfolio is down 10% or 12%, but I still need to pull that 4% to live. Now I need to pull more. And then when it bounces back, I'm more behind. And then with growth, obviously it's more volatile. So that will hit harder. Versus if I have dividends, it's more stable. And then I don't have to sell my shares to be bringing in money.
Mhm.
And then I'm also just a little bit confused. Like I know you pay taxes on dividends in a taxable brokerage account, but since this is a Roth IRA and all of my gains are tax free, are my dividends also tax free, or like how does that work?
Great question. First of all, there's quite a few. So like let's break them down step by step. I want to
Mm-hmm,
start with first the let's start with the dividend question first, like focusing on growth or stock growth or dividend income.
mm-hmm.
I guess my first question for you, Elise, is what do you care more about? Like, do you care more about maximizing your growth potential over the course of your investing, journey, over the next, you're young, so you have, a good 20, 30. Ideally, you're going to be able to retire ASAP, but you have a good amount of time frame to let the market work in your favor. So, like,
Mm-hmm.
would you say you care more about maximizing your growth potential over the next 20 to 30 years or generating more consistent income slash stable income? Like, which one of those appeals more to you?
I kind of feel like I prefer the stable income because it's like, okay, I know that I have X amount of money invested, so I know every quarter I'm going to be bringing in an extra, I don't know, $1,500 or an extra $1,000 that I can do whatever I want with, whether it's reinvest it or spend it on myself. But I'm afraid that if I go that route, let's say my portfolio ends up being worth $2 million. I'm afraid that if I go that route and I'm getting that consistent income, that I look back and be like, damn, my portfolio could have been worth 6 million if I just did growth.
Mhm.
So
Yeah.
that's where I'm like, frick, like, what do I do?
No, and you're definitely not alone, like facing this dilemma, because there's so many people that have the same exact question as you and that they're facing this exact situation. They're trying to figure out if they should focus more on the growth aspect of their portfolio or the dividend aspect. Now, let me give you some context or some insight that might help make this decision easier to make. The
Mhm.
first thing is the stable income does, although it's stable and it's nice and it's safer, the risk to it is underperforming the stock market. So, like, there's a cost to
Yeah.
it. And that cost of
Mhm.
safety is missing out on potential growth long term. Now, the reverse is also true, where if you only focus on the growth aspect, you do have more risk that you're exposing yourself to during the choppy parts of the market, right? Like when things start to go south, when everybody starts to hate on the stock market for a year and everybody says stocks are bad, like it
Yeah.
gets harder to kind of stay consistent, when you see your portfolio bleed. So like sometimes those dividends kind of bring in that extra stability of your portfolio and can help kind of offset some of the ebbs and flows of the stock markets. Now, for me personally, I like to focus not just on stock growth or dividends, like one or the other. Like I like to focus on the overall returns. Like I like to zoom out and like let's see, how much these different funds return when we combine both of them together, right? Because for
Mhm.
one, dividends are, in my opinion, are basically like a nice bonus, but like most of the magic in the stock market comes from the stock price growth. So like over time, most of the growth comes from companies continuing to generate value or like grow their business. And then the more they grow their business, the more value, like the more their company becomes valued and more investors want to buy those shares. Like that's what drives up the price over time. So
Yeah.
like my thing is like you can technically have both if you set up your portfolio the right way, which is why I'm a fan of VOO, just like an S&P 500 fund. It's because you
Mhm.
get the growth aspect, but you're also getting dividends.
Mhm.
VOO pays right around 1.3% per year. Like it's not a lot, but it's at least giving you some stability in your portfolio where you can still count on that dividend, even if we go through a year of choppy markets or like a downturn, like you're at least going to still get some payments, some consistent payments to your portfolio. So like you can kind of have a little bit of both, which is why I love the S&P 500s because you get both the growth aspect and the dividends. But I will say, like if you do, like you could always do this approach as well, like where you focus more on the growth aspect, over the next 10 years. And then as you get older or closer to retirement, you can start to rebalance your portfolio more towards the dividend side of things or more so towards the consistent income side of things. So like even though
Mhm.
you might implement a growth strategy right now over the next 10 years, it doesn't mean you have to stick to that forever. Like you can always like change things to become more safer like as you get closer to that retirement year or as you get closer to the time when you're going to start withdrawing from your portfolio. Does that kind of make sense?
Yeah. Yeah, that kind of makes sense. And so, well, yeah, I think it makes sense. I feel like it makes sense, especially because like it's in a Roth, because like correct me if I'm wrong, but if I do this on growth and I go hard on growth, then in the future when I sell it and then start buying dividend stuff, I'm going to be paying taxes on all of that stuff, right? On
So
all the growth, the sales from the growth.
So if it's in the Roth, it's all tax. Like there's no taxing. So like you aren't gonna have to pay anything on the growth or the dividends if it's in the Roth. And of
Mhm.
course, you have to wait until you're 59 and a half. So like that's the criteria. Like
Yeah.
of course it's a nice tax benefit, but the cost or like the way to get that is you have to wait till you're 59 and a half to start
Hmm.
accessing it. But yeah, that's the beauty of Roth IRAs, and that's why people talk about them all the time, is because you literally bypass the IRS. Like you don't have to,
Hmm.
you're not going to owe them a penny like even if you buy like Nvidia or some big stock, like let's say that grows 200% over the next like 5 years or whatever, 10 years, if you have a massive growth stock like that, you're not going to owe a single penny on it, because it's in that Roth IRA, which is why these accounts are so damn powerful.
Mm-hmm.
Yep, exactly. And I'll say for um, just to kind of touch on what Josh mentioned a little bit in terms of like the dividend route, right? That consistent income route versus like focusing on the growth. For dividends to be like super effective, generally it would require you to actually contribute a lot more, right? Because basically you're forfeiting the growth and you're forfeiting the growth and supplementing that growth with your contribution to kind of help stimulate more dividend payouts, right? On the other hand, with growth, is like the growth benefits investors more, especially since if you have time on your side and you're young, and then also if you're not contributing like a ton of money, right? Not everybody has a insane amount of money to put towards the market, so the growth actually makes up for the lack of financial resources that you don't have to put into the market to make it grow faster. You know, and if you take the growth route, you can later, like you said, you can convert it later, right? You can get to 59 and a half, be like, you know what? Okay, cool. I've gotten the growth that I need. I'm going to switch it to more of a dividend fund and get that consistent income. One thing to keep in mind is typically by the time you need that consistent dividend income, you don't have as much time for the money to grow, right? Because if we're talking about, let's say, 59 and a half and it's been in dividends, of course, it's been growing over time with the dividend funds. But if you need more growth at that point, it's going to be a little bit tougher. You would then have to convert and then take on like a growth risk that maybe at 59 and a half, you might not have as much
Yeah.
flexibility to be taking such a risk, right? So I think consistent dividend is good, but we also, another thing to keep in mind is we also don't know what the cost of living will look like, right,
Yeah.
in 20 to 30 years, because right now, yeah, maybe the dividends are good and it's cool, but maybe in 30 years, if we had focused on growth, we would have had enough to then get the appropriate dividend income that we need to enjoy whatever the cost of living is at that time, right? So I think focusing on growth when you're young is ideal. And then it's almost like a hedge against if you don't have enough funds to put into the account because you're going to get a good amount of growth. And then also, depending on what things will look like 30 years from now, growth is probably one of the best hedge against, getting to the point where you don't have enough to live on or retire on. So I'm the younger you are, the more growth. I'm a big
Right.
advocate on that because
Yeah.
by the time you're gonna need that dividend income, it's gonna be way later. And
Mhm.
if this next 20 to 30 years go by without you literally leveraging the system to maximize what you can get, it's going to be a little bit tougher later on because you might not be able to work as much. Who knows? Our health could change too, right? Anything can happen at the later stages. So when you're young, I'm more of a proponent for growth than dividends, unless you're contributing like 1,000 a month, right? Like you're going ham, you got like
Yeah.
5,000 a month going to
Yeah.
dividends. Then in a relatively like midterm timeline, you can definitely be more comfortable with dividends and get that income. But yeah.
Yeah, that's a lifestyle I'm not at yet right now. So growth is.
And then
Well,
another cheat code is like with growth, even if you have enough funds, right, or you're contributing a lot, it's gonna grow te- so much faster than
Hmm.
even the dividends. Like if you're doing 100 a month to growth, it's gonna grow. But imagine if you're doing 1,000 a month to grow. Of course, higher
Hmm.
risk, higher reward a little bit, right? Because
Yeah.
the swings will be a little bit more heavier, more volatile. So psychologically, you got to be somebody who can stomach that as well. So that's important.
Okay. Yeah, honestly, I feel like well, obviously it's been like pretty much baby dollar amounts that I've been putting in, but I don't think I've ever been bothered. Like I started investing not that long ago. Like I think I opened my account in like 2021 with you, and
Mm.
then I didn't do anything with it until like late 2023. That's when I was like, you know what? Maybe I should actually start taking this a bit more seriously.
Yeah.
Um, yeah, it was late 2023 because that's when I had to save up to like I just realized like bro, like I have no savings right now. What the hell am I doing? So then that's also when I pretty much started taking my financial literacy journey, I guess, like more seriously. And then that's when I started like the contributions to the Roth IRA. So since then, like those little like scares. Like I remember we had like one day the stock market crashed like 15% or something like that, like some October or September. And I looked at my portfolio and like the only thing that I thought was like, damn, I wish I had a lump sum back then. But it was never like, oh, I'm gonna
Yeah.
pull money out or anything like that.
Uh,
So I feel
That's
like I'm
awesome.
pretty good at stomaching
yeah,
that risk.
that's good.
Well, it sounds like you have like a long-term mindset built out, which is super powerful because like
Oh
you're
yeah.
not playing this game in a 5 day with a 5 day mindset. You're playing it with a 5 plus, 5, 10, 15 year mindset. Cause like that's your
Yeah.
goal is like you're trying to grow long-term wealth. And when you have that mindset, it's a lot easier to take advantage of the red days and of course not panic sell. So it's a powerful mindset to have. And I also wanted to circle back real quick to the dividends because I have a little bit of extra context to add for
Mhm.
you, and then as well as anybody listening. Where the reason why I think dividend stocks, like of course they have their place in anybody's portfolio, but the reason why I'm not a huge fan of them is because like I personally would rather own companies that are reinvesting their profits into growing the company,
Mm.
right? Like, because like when companies are paying out profits to investors, like of course it's nice, like it's a nice like consistent payment, but it's also money that they're not reallocate into their business to grow it. Right. So like that, I would rather the businesses be in a stage where they're like continuing to dominate in the business world and they need their money because they're growing and expanding and they're trying to innovate and build more value for the investors. Like I would rather them take that dividend payment and reinvest it rather than me take it and then maybe go spend it on, coffee or whatever. Like I want them to take that money and reinvest it because that's what they're doing best. That's why I bought the
Mhm.
company to begin with. Now, that's especially true when you're in the growth start of your investing journey. Like the first 5 to 10 years, in my opinion, especially if you're younger, like you should take advantage of being young and having that opportunity, kind of like what Baafi highlighted, of being able to withstand more of the ups and downs and be able to withstand, some of the fluctuations, maybe even your own income. Like take advantage of that because, like you said, like you're not going to be able to. It's going to be harder to take more aggressive risks when you're in your 40s or 50s compared to
Mhm.
when you're in your 20s and 30s. So
Yeah.
that's something to kind of keep in mind as well.
Yeah,
Oh,
and Louis, you had the second part to your question was really when it
when
comes
it
to
comes to
dividends, right? Are you going to have to pay taxes on that? You know,
yeah.
so dividends are taxed at your ordinary income tax rate, right? And so it's either 0, 15, or 20%. Okay, and it all depends on one's income, but the difference is if the dividend funds is in a Roth IRA or like a Roth account, then you actually don't have to pay taxes on the dividends, right? So if it's in a Roth, you get paid dividends and you just reinvest it, you don't ever have to pay taxes on it. But if it's on like a regular taxable brokerage account, then you will owe taxes even if it's reinvested or not. So obviously, it's always best to kind of have your auto investment,
Mm.
setting set on because why not, right? The money comes in, it goes back to work. You're not even feeding it, as you're feeding it, it's also feeding itself that way, right? So it's like you got two contribution mechanisms going on for you. So that's really the main things there. Dividends in general, yeah, you're gonna pay taxes on it. If it's in the Roth, you're not paying tax on it, which makes Roth even sweeter. Like Josh was saying, that's why
Shout
you
out
hear a
to the
lot more
Roth,
about
man.
it. Yeah,
Yeah.
because the tax advantages and incentives is really there, right? With a taxable regular brokerage account, yeah, you do have to kind of consider those dividends will be taxed on.
Okay. Um.
I also know, Lucy, you had that last question I want to tackle, and then I probably have to get running here pretty soon. But let's tackle that last question, or I think it was like somewhere in the middle where you touched on the 4% rule.
Yes.
And
That.
great question, by the way, where your question was more along the lines of, hey, if I'm retired and I officially hit my financial freedom number and I'm ready to consistently start withdrawing 4%, but then let's say there's a year with that you're consistently withdrawing 4% every year to live off of. Let's say there's a year where the market drops 20%, 15, 20%.
Yeah. I know
Like,
the
Yeah.
how,
feeling.
this is a great question. Now, the reason why the 4% rule still works and like you would still want to continue to withdraw 4% even during that crazy period is because also keep in mind, like during the good times, like when the market's up 20% or 30%, like it has been the last couple of years, you're also only withdrawing 4%. So like those
Hmm.
good years, like the whole reason that 4% rule works is because the good years offset the bad years. So like the bad years typically occur not that often as the good years do. So like, we'll see years where maybe we're down 15, 20, 30, maybe even 40%, but those are more rare compared to the green years. Like if you pull up an S&P 500 chart and you look at every single year, like the yearly performance, there's a lot more green years than there are red years. So the
Mhm.
reason why that 4% rule works is because, yeah, not only are you going to withdraw during the bad years, but when the market's outperforming and your portfolio is growing like crazy, you're also only withdrawing 4%. So like those good years are going to offset those bad years. Does that kind of make sense?
Yeah, yeah. And I think like my last small question is how do I convince somebody to like start? Because
You,
there's one
we're
person
still
that
trying to figure it out, man.
I'm really
you
trying to
you
get him.
can't you can't. That's one of the
No.
that
I think
that's
she heard me, bro.
you heard you, yeah. That's one of those very difficult life things to kind of digest and accept, right? It is whenever we are doing well or we find a good information, some good information that can help the people we care about benefit, right? We want to share it. It's just human nature to want to help and contribute and make things better, you know. Um, but by the same token, you have to also give a lot of grace in terms of the lack of, I guess, in some cases, urgency, right, for people to kind of adopt a new way of thinking, a new way of operating, right? It took, if they're 20 years old, it took them 20 years to get there. If they're 30, it took them 30 years. And the older people get, the more their habits are deep
Yeah.
rooted, right? That's why sometimes we have a problem with the older generation. Like, hey, you guys are too old school or whatever it is. And so it's going to take time and it's going to take a lot of different angles or different ways of communication and a ton of patience, right? Now, you could do everything right. And if the person is not ready, the person is not ready, right? It's like you can't make them do it. That there has to be certain things that click that starts to get them to see it. I would say if it's somebody that's like a significant other or a very close family member, whether it's a younger brother or a sibling or something like that, I think one of the best ways to go about it is one, kind of plant little seeds, right? Because I've realized even if you're telling somebody something good that can help them, we don't like change as humans. We like what we like. We like the way we think. Because now it's like, oh, you're forcing me to think about and change my brain. No, no, I like my brain the way it is. I understand it. It understands me, right?
Yeah.
So one of the ways to do it is first just little plant a little bug, little trees, right? Just little comments, not even like direct things about investing heavy or whatever. Just a little like, oh wow, man, I heard a story about X, Y, and Z, and Warren Buffett of mine. That's pretty cool. Wow, cool. And they just leave it at that. Don't say nothing else on, boom, just little nuggets. So that's one way to kind of keep it light and entertaining enough for it to just at least start turning the screws a tiny bit, right? Not a lot. The second way is as you're doing well, if you feel comfortable and you feel like sharing, you can kind of let them see a little bit of the growth, right? Like kind of, because I've realized when people, dude, you could be saying the best thing ever. If people can't see it, if they don't see that you got it like that, dog, it's hard for them to believe it, right? So let's say, oh, at the end of the year, your portfolio grew 20%. You'd be like, wow, I've been working at this job. I didn't get not even a 20% raise. I didn't even get a bonus, but guess what? I had some money working, and look, the money did X, Y, and Z, right?
Hmm.
And then people will look at him like, oh, wow, okay. They might not understand a damn thing about it, right? But the fact that your money's growing and you're not doing anything and it's growing, that is attractive. That's sexy to all of us.
They'll start
If
asking
somebody,
questions.
yeah, they'll start asking, they'll be like, yo, what? It grew by, you got an extra 5,000? Just, how did you do that, right? So
Uh-huh.
it's just little things. And the third thing I would say is you have to make sure that you study the person, right? You have to know your audience. You have to study the person and see how they operate, why they operate the way they operate, right? Because there's people have reasons, right? They have reasons and circumstances and environments and backgrounds and certain stressors and things that has gotten them to think the way they think. So if you're able to understand them more and their background a lot more and what their fears are and everything that's pulling on those strings, it's a little bit easier to connect and relate and then kind of have a good strategy to be able to teach them, right? But this is something that takes a long time. Trust me, I have nieces. I have family members, I have friends, I have cohorts, and I can promise you, some of them have been following me for 5 to 8 years, and they've literally seen all my posts, they've seen every story, and to this day, they're still not doing it, right? It doesn't mean that they don't want to. They might have good intentions, but sometimes it's just like a, falump. It's like just in the ether, not like
Yeah.
right here. Sometimes life might be the thing that forces them to do it because they might see a situation, they might see somebody's story or hear something, or they might realize like, dang, everybody talking about the stock market is doing X, Y, and Z. If I had started 5, 10 years ago, I might have had this, right? So it has to, for some reason, it has to kind of hit them like life has to hit them a certain way in a certain angle for them to actually get it. Now, sometimes it has to hit them in a good way. There are times that it has to hit them in a bad way before they kind of, get to that point. But in terms of how can you get someone to just do that, we're still trying to figure out that answer, man. Like Josh said,
Listen to
it's
our
hard.
podcast. Listen to the
Yeah,
podcast.
All right, I'm
yeah.
gonna send the link out.
Yeah.
Yeah, exactly. The podcast would definitely help them over time. And
Yeah.
it's so delicate. It's very, very delicate, right? It's almost like think about it when you was younger, and you're living your life, whether you're
Oh
playing
yeah, I was dumb.
basketball all the time or when you were
Games.
playing your GTA, right? Whether it's Vice City, whatever it is. And your
Yeah.
parents might have been trying to like nudge you to maybe spend a little bit more time on your books or something. You know how parents are, right? Think about how difficult that was for you to adjust and kind of get to the books a little bit more so your grades can be better, right? Think about how stubborn
Mhm.
we were back then. I
Yeah.
mean, we're still stubborn as hell. I'm stubborn as crap. I'm
Oh
not gonna
yeah, I'm
lie,
still stubborn.
right? But think about how long it took you, probably many years, to get to the point where you're like, you know what? Maybe I need to take certain things a little bit more serious because life is lifing, right? And then you turn it on. And then once you turn it on, you're like, okay, cool. I see the vibe. I see the evidence. I see the life that I want. I also know the life that I don't want because maybe I was experiencing it. So now it's easy to sustain your new mentality, your new growth mindset, right? So you got to have the same level of like patience and understanding. And trust me, I know it can get frustrating. I know it can. Trust me. Sometimes you're like, damn, right? Like even if you're not careful, that frustration will like become a wedge in your relationship with the person. You know what I'm saying? So
You definitely got to tread lightly on
yeah,
it.
you got to
And
tread lightly and you got to let it kind of roll off your shoulder because you also don't want to rob people of the ability to experience life and learn their
Mhm.
own way, right? Think about sometimes like the same thing when we was growing up, your parents might have said something 10 times and then they'll stop, right? When you get burned, then you're like, oh shit, yeah, my parents were right. I'm not doing
Yeah.
that no more. So
Yeah. Yeah.
sometimes unfortunately might be painful because they might complain about their finances. They might complain about their job, whatever it is. But you literally have to just watch and witness and just let them figure life out. And I think that's probably one of the hardest things about being a parent, right? Because you can't protect your kid from reality and from the world 100%. You got to literally give them room and space to navigate and cultivate their own path along with it. And you're going to see them in pain. You're going to see them crying. You're going to see them frustrated. You're going to see them mad, see them upset, feeling like the world is treating them unfairly. And they might be right, but you have to give them the space, you know? Josh,
Hmm.
what's your take on that?
I completely agree. I mean, I really think just to kind of maybe tie it together is I would just aim to be the person there ready to help when people are ready to learn. So whether that's your family, your direct family, your significant other, like whoever it is, like we can't force people to learn something they're not ready to learn, but we can be there ready to help when they are ready to learn, and we can continue to set an example of what's possible, by learning ourselves and then showing them the benefits. Like, hey, kind of like Baafi said a little bit earlier, like just showing them like, oh, hey, my portfolio was up 20% this year. Like that's kind of what gets people start asking questions or gets people curious. And I think really it's just trying to get people to be curious to begin with. So like just setting the example, being the beacon of lights for when people are ready to kind of go down their financial journey routes. But yeah, it's you can't tell somebody something that they're not ready to hear. And that's something I've learned, the hard way over the 6+ years I've been making financial education content. You can only be there for the people who are ready to learn and try to inspire them to start their journey through the results you have or through the insights that you have that you've kind of realized. Like just sharing those, kind of what Baafi said, like just like little nuggets. Like obviously you don't want to like dive into the details of like, all right, sit down, we're gonna go through every detail on the Roth IRA. Like that's
Yeah.
gonna be bore the hell out of people. So like, you just
Yep.
gotta like share the little
Yeah.
nuggets. Like, hey, did you know that it's with the Roth IRA, everything's 100. You can escape the tax code essentially. You can bypass the IRS. Like that gets a
Not
lot
too
more
loud. Not
attention.
too loud, Josh. Not too loud.
They're gonna cut this off in a second.
Yeah.
But
But yeah, I
that's really
get you. I
that's really
get
what
you.
it is. Yeah.
Yeah, now it's true, and you also don't want to be the guy that is like, because otherwise people they're gonna get frustrated with you, right? You don't want to be the guy that is like every time y'all interact, you're talking about money and investing 24/7, right? They're gonna be like, oh, here he comes again. He wants to be bothering me with this crap, No, of course, yeah, we need to definitely normalize talking about money, right? That's something we don't talk about enough, but we also got to know when and what environment to kind of you got to, it's like picking your battles, right? You got to know when is an appropriate time to kind of have those type of conversations a little bit more, right?
Mhm.
Maybe that person you're trying to help or help guide, they might see something that piques their interest. They're like, yo, that's crazy. Did you hear about this story or whatever? That, and if it relates to that type of piece, then it's already like they've kind of opened the door halfway, and then you can kind of sneak a little information and kind of connect it to what they're just got excited about, and then boom, right? That also plants a seed. So yeah,
Okay.
yeah. So just patience is definitely number one. We got to be very, very patient.
All
It
right.
could take,
Bet.
and it could
Yes.
take people. It could take people. Some people can get it in a year, in 6 months. Some people can get it in year 10. Like
Hmm.
it just, you just don't know. It's certain, the stars have to align a certain way for people to then be open to it. And I agree with what Josh said, man. That's so important. Just the most important thing is just to be supportive and always be available, especially if they end up, feeling comfortable enough, vulnerable enough, right, and kind of letting you in and share and be like, hey, look, I can learn. I can use some of your help on this. I can, I want to make some progress here. If they come to you, that means that one, they trust you, right? If they didn't trust you, they wouldn't come to you in that fashion. And it takes a lot of people a long time to build that trust because they have to see certain evidence, right? They have to see you over time and see how consistent you are and all
Hmm.
of those things first. So, yeah.
Okay.
This was a lot
Do
of
you guys know when we're gonna do the next call? Because I've got other questions, but it's not related to this topic, and
Mhm.
plus, it's getting late. I'm not gonna
Yeah,
hold that
yeah.
up.
Josh and I would definitely deliberate on that and then send it out to the group, similar to like what we did today as well. So yeah, we'll
All
this
right.
this
Bet.
was a
definitely have
lot
some
of fun
more.
though. It was nice
Yeah.
to get back in the swing of these. And yeah, we're gonna plan. I think this would make a good podcast. So we'll upload this on the podcast because
Ooh,
you
yeah.
guys asked some great questions, and
Hmm.
hopefully you learned a lot. And of course, if you're asking questions, odds are there's thousands of other people out there that also have similar questions, so they'll also be able to learn. So like, I mean, I appreciate you coming on here, being willing to ask the questions, because sometimes that's the hardest part, is to
Yeah.
actually be curious and ready to learn and ask the right questions to help get things moving in the right direction.
Yeah, shout out to
Yeah.
Queens as well for getting on, man, for providing some really important questions that I'm sure many people out there have, and they might not have access to us directly. But guess what? Because Queens asked it for you, you got some answers, and if you listen to this episode, now you can take advantage of it too.
Yeah. Shout out to y'all too, bro. This wouldn't be here without y'all. So appreciate your guys' efforts to help everybody.
Anytime, man. That's what it's all about. That's what this whole community is about.
100%, man. 100%. All right, guys. Well, yeah, this was fun. We'll post the schedule for the next one soon. And other than that, I hope you guys have a good rest of your night.
Yeah, enjoy your weekend. Have fun. Be safe.
Yes, sir. You guys too. Take it easy.
Thanks. See you next
Take it
time.
easy, man.
Peace out.
If you feel just like I do, link up, come and join this crew. Hey, I'ma go invest and I'ma watch my money double, take it to another level. With that market hustle, ay, always play it smart. You ain't dealing with a sucker, take it to another level. With that market hustle, I'ma hustle, ay, hustle. With that market hustle, I'ma hustle, ay, hustle. With that market hustle, I'ma hustle, hustle. With that market hustle, I'ma hustle, hustle. With that market hustle, go.